I'm Samantha Rowan, and this is REFI TV. Today's guest is Howard Roth, the global leader of real estate for Ernst & Young. Thank you for being here today, Howard.
Oh, pleasure. Great to be here, Samantha. Nice to see you.
Sure. Nice to see you, too. Now, I just read through EY's 2010 Global Real Estate Investment Trust report. The report suggested that the downturn was a really good chance for REITs to really stress test their structure. What did you guys find?
Absolutely. I'd say, when you look at REITs, I think what really came out of the report and the turmoil we've been in the past few years is that liquidity, transparency, ease of access to capital just have huge value in the real estate marketplace. And when you really look at REITs as, generally speaking, being vehicles that are modestly leveraged, generally speaking, if it's 50%, 40, 60%, clearly you have a significant equity cushion that could really help you, cushion the blow from a significant downturn. At the end of the day, I'd say aside from maybe one or two real anomalies, you didn't see any sort of wholesale failures of REITs, and I think it's really helped REITs continue to make their name and enhance their name as a vehicle of choice for all types of real estate investors.
Yeah, and especially if you look at the returns that the sector's produced over the last couple of years, they've been very, very strong.
Very strong in the United States. I mean, I know, you've seen our global REIT report, for last year, and we're, finishing our report for this year. Generally speaking, very strong returns. A lot of interest in the sector. A couple of countries were a little bit less strong. I know we talk about Australia a little bit, which generally speaking has a very strong economy. But in that circumstance, their REITs were really more highly leveraged. Than many of the other countries. Their REITs tended to price off of dividend yields and returns, and so during the upturn in the market, they continue to borrow more and more and more. So the decline, obviously as things turn south, the decline in their values, their stock prices was even greater. And similarly in the the UK didn't have the greatest performance. Has a good REIT market, but at the end of the day, the leverage was a little less. Is a little less available. Senior debt's a little less available, and it's kind of restrictive just in terms of their rules. And so the proliferation of REITs, new REITs that was hoped for, didn't quite happen. And but nonetheless, it's better to be in the game at the end of the day than not be in the game. And clearly, REITs, I'd say macro level worldwide, really showed themselves as vehicles that were very not just flexible, but can continue to support themselves.
And also, just to talk about the UK and Australia for a bit, do you think now is a good time for institutional investors to consider adding those regions to their allocations?
I think it's probably a pretty good time, to be looking at both of those regions. I think that in, again, Australia, very strong economy, primarily driven by, commodities and what comes out of the ground. And clearly there's neighbors to the north, China, many of the other developing nations will buy as many commodities as they can produce and sell. And, their banking system is strong. And I think they've, generally speaking, moved past and of their sort of over-leveraged situation going back 2007 to 2008, and so banking system strong, economic parameters in terms of their economy strong, and I think it's a good time to be thinking about Australian REITs. In the UK, similarly, I'd say the dynamics that were at work there is that you really had REITs, at least a lot of folks felt, that were trading at well below net asset values, and again, wide variety of circumstances that we talked about, and I think that creates opportunity, and even out at MIPIM, you hear clearly some of the institutional investors and others really taking a look and a relook at some of the the public companies in the UK.
Yeah. That kind of leads me into my next question. Lots of people say that institutional investors are thinking of directing new and rebalanced dollars into REITs. Are you hearing that?
Yeah, we actually, I say in my role, I travel around a lot. I talk to a lot of folks. I think there's clearly a movement, at least a greater interest on some of the the part of some of the pensions and endowments and other institutional capital and REITs in the public markets. They see how they've at least survived, much less in many cases performed pretty well, over the past couple of years. So that's a real, I think a real interest. And I think one of the things that's actually sort of interesting, that's happening is you see some of the real estate public company associations, certainly NAREIT, here in the U.S. and EPRA, and they are really looking to capitalize on the strong performance of the public REIT sector in really enhancing their brand and really reaching out to pensions, endowments, institutional capital, as really even further thinking about them as a vehicle of choice. So I think that paradigm is really underway.
Yeah, NAREIT did some really interesting research. I think it was almost a year ago now, where they compared REIT performance over the long term versus direct investments over the long term. It was a pretty interesting piece of research that they did. Also, what do you think the long-term impact will be of greater investment in REITs as opposed to direct investments? Generally
speaking, I think that REITs are a great type of vehicle for all property types. I'd say to me the macro dynamic is that more globally, more and more countries are putting creating REITs and having REIT type of legislation as a way to help encourage investment capital to come into their countries. Mexico just recently enacted REIT legislation. Several months ago, the Philippines, China, it's a little different dynamic, but is talking about it. And the way I sort of look at it, going in, back in the 60s, the United States was the first country in the world that had REIT legislation. Now there's over 40. I don't know any that have gone away, right, and only continues to increase. And I think, many of the developing countries, around the world are really realizing that it's a great way to attract capital to their countries and to their real estate market. And so I think that's all positive.
Now, shifting gears a bit, I've heard that many private equity funds still have a lot of cash on hand from what they raised at the start of the downturn. Where are they looking to deploy this, and are they deploying it right now?
Well, there's, I guess a few points. I mean, clearly there's certainly a significant amount of existing private equity capital on the sidelines available to be invested. And even if you go back to obviously the funds that were raised in 05 or 06, 07, 08, huge capital raising years. Significant amounts are committed but uninvested, so that's still available. Folks are looking, I'd say, it's interesting, more cautiously, generally. And while there's opportunities out there, it's like you really have to find your pick your spots and find your right opportunity. I think that, it's more, while there are opportunistic situations that are out there, they're still more difficult to find, given, we talked about it a little bit before, government policy, low interest rates, quantitative easing, but basically there's no catalyst, the way I think of it, that has forced banks and other institutions to move their over-leveraged real estate, off their balance sheets. That would be great opportunity for private equity, much less any other real estate investor. But the reality is, it's more around deferral, and it's more around amending and extending loans, and so it makes it again, it's opportunities, but maybe a little bit more difficult to find your right opportunity for at least for opportunistic type of investing. For core and core plus, and obviously a lot of interest in trophy assets in major gateway cities. I mean, we see it everywhere in New York and DC and London and Paris, and you can go down the line. But that's sort of a little bit different from at least what some of the other value add and opportunity funds and how they would deploy their capital.
With the capital that's on the sidelines, how comfortable are investors with the cash levels that these private equity funds have right now?
I think they're comfortable. I think the question is more along the lines of, to the extent they have, committed capital to these funds, that's what's available to, to invest. I think maybe the point there is that very clearly over the past, 2-3 years, during this difficult period, very clearly limited partners became, much more actively engaged with their general partners and their sponsors. Clearly part of that message, certainly going back the past, 1 to 3 years was, hold on, wait, are we in a free fall, aren't we, what's going on? And so, I think that, they got more engaged with their capital and cash that was available, and I think that sort of led to the capital that's available right now. And the sponsors and GPs, again, sort of picking their spots, looking opportunistically, and not feeling the same level of pressure nor their ability, quite frankly, to just put out capital on a wholesale basis for any deal that might be out there.
Sure. Now, we've talked about funds that have raised capital already, but we haven't really touched on a lot of the new funds that are trying to raise money. How's that working for the funds that are out there trying to raise new funds?
I got to tell you, it's really, really interesting right now. So, generally speaking, the capital raising environment has been difficult, right? Capital on the sidelines. We had, I'd say, a period of, over the past 24 months of a lot of folks talking about launching funds, sort of a lot of hype, but actually not a lot of new funds raised. And I think right now, just the past 2 or 3 weeks, you've seen a number of, announcements of major private equity players. You look at, TPG and KKR very recently, looking to establish, full-blown platforms. You've seen a number of other, I'd say, geographically focused players who maybe have a strong track record in a particular location, London, New York, you can, pick it, wanting to maybe capitalize on their, sort of private track record and are looking to raise capital. And so I think we're, moving into a period where now the pensions and endowments are the primary investors and, opportunity funds are, sort of slow recovery, understanding or thinking about the rebalancing in their portfolio, thinking about the denominator effect a little bit. And, I think the sense is that over the next 12, 24, 36 months, that if you believe there's, real estate is taking a real hit and is whatever, significantly undervalued from its, from its peak, that there should be opportunity. And my sense is that it's going to be a significant amount of, successful capital raising over the next 24 to 36 months. I guess, and I think the point there also is, really, I think the strong, but it's the strong players are going to have opportunity. The ones who have come through this downturn relatively successfully. And I think there's going to be significant opportunity for a number of these niche players who have always been private and under the radar screen, but have, really strong track records and are really looking to almost, partner maybe with a fewer number of institutional capital sources, to leverage off of their success and experience in local markets.
That's really good to hear. And that's all the time we have for today.
Oh, well, thank you very much.
Yeah.
Really enjoyed this. A pleasure.
Thank you for being here.
Thank you, Samantha.
And I'm Samantha Rowan, and this is REIT TV.